Trump recently talked about a 50-year mortgage as an alternative to make housing more affordable. Is this a good idea? Well, let's look at the numbers, because obviously it would drop your payment, but at what cost? Hi, I'm Jake Tysiak, your bourbon drinking realtor, and we're just looking at the numbers today. We're not buying into politics. We're going to put that crap aside and see if this is a good idea for today's homeowner, or home shopper, I should say. So for today's example, we're purchasing a $400,000 home, and we're going to be putting 20% down, which is going to leave us a mortgage of $320,000 and an interest rate of 6.5%, which is very doable in today's market. So with a 30-year mortgage, you're looking at a monthly payment of $2,022 for principal and interest. You're going to have taxes and insurance as well, but the principal and interest is really what we're going to focus on today for the two comparisons. Now, when you switch it over to a 50-year, you're going to drop your payment, but your payment is only $1,803. So you're looking at a difference of about $219, roughly 10%. So yeah, it's lower, but it's not as much as you probably thought. And really what we're looking at is, what's the cost of that lower payment? Well, here's the thing. When you're making a payment on mortgages, oftentimes you're paying a good amount of interest, if you've looked at it or not. When you're looking at a 30-year mortgage, over the life of the loan, you're going to end up paying $408,000 in interest alone. And that's not a small chunk of change. That's more than your original amount of the loan itself. And that's because we have so much time on our hands. Now, when you do extend it all the way out to 50, you bump that number all the way up to $562,000. That's a difference of over 350 grand. That is a hell of a lot of money. Not to mention, if you change terms and you put less than 10% down, guess what? You're going to pay even more. That's because with 10% down, you're going to need private mortgage insurance. And normally with a 30-year loan, it drops off when you hit about 20%, which your standard payment would be 8 years. Kick that out another dozen years, 20 years before you would pay that off with a 50-year mortgage. And that's going to add probably about another 24 grand to that same purchase price of $400,000 when you change up those terms. So you can see it is definitely a lot of money. And the big contributing factor to that private mortgage insurance is just that you don't pay a lot off of your principal in your early years of your mortgage. With a $400,000 purchase price, 10% down, you're going to be paying over $23,000 in payments to the bank. And guess what? You're paying less than $1,000 down off your balance because you just got so much time. So as you can see, I think a 50-year mortgage is just crazy. 30 years is a good option for most homeowners. 15 is even better. So I'm going to leave a link down to a video down below that can show you how you can actually shave years off of your mortgage. And of course, if you have questions, feel free to give me a call. I'm Jake Tysiak with Keller. Thank you so much for watching. Hope to see you in the next one.